Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.Academy. So in this course, we'll be looking to discuss trade management. So just before we get into outlining exactly what you can expect over the course of this webinar, please do take a brief moment to familiarize yourself with the disclaimer currently up on screen, and just always be aware of the risks involved in trading these financial markets. Okay, so moving swiftly on then, let's start with a webinar outline. So we'll start with an introduction to trade management. Then, before we delve into the practical application of trade management, it's important to ask a series of questions before entering the market, because that can often predetermine how you would go about managing that trade once you've entered. So then we'll break down trade management in practice. We'll have a look at trade management gone wrong, because there is a right way and there is obviously a poor way of managing your trades. And we just want to highlight perhaps one or two examples that you can mismanage trades as well. And then we'll finish off with just a few conclusions that we can draw when we talk about trade management. Okay, so let's start with a definition. Trade management simply refers to everything a trader does after a trade is executed, and the reasons, and this is to effectively maximize potential profits, which is why everyone looks to trade these financial markets. But it also performs a very important role with regards to minimizing risk, and it's also important to add it's the minimizing of risk as quickly as is reasonably possible. So that's quite an important distinction to make. And that is very much a judgment call and really about decision making. So just a couple of points to add. Trade management is not only about placing a stop loss, which is kind of a common misconception. We must manage profit as well as loss. Because if you can imagine, if you're in a trade and you happen to be up 100 pips, and if you forgo that 100 pips because the market pulls back, then you're not ultimately managing that trade effectively and efficiently. It obviously does, of course, take into account your stop loss. Hopefully you are trading with a particular risk reward in mind, whether it's positive or negative. But the idea is try not to give back a serious amount of profit. Try to at least get into the routine of being able to book in those profits as often as you can. And this is where trade management can play a very fundamental role. So good traders constantly revise their trade positions at regular intervals as new information becomes available. So that's a very, very important part of trade management. So sometimes we can be in a particular trade, it can be performing quite well, and all of a sudden there's a news event of some kind. And of course, it can impact that trade, and it can impact it positively and negatively. But the important part is to revise, constantly revise, and keep referring to those trades, and be aware of the news flow and the information that can impact the trades that we're in. Next point is to aim to monitor risk while allowing the potential to stay in winning trades. So this is the principle that we were alluding to earlier. About minimizing risk as quickly as is reasonably possible. And so the aim is very much to monitor risk, constantly assess and gauge your risk exposure in a trade, but looking to give that trade as much room as you can without being reckless with your risk management, in order to give that time or give the space for the trade to develop somewhat. So also it's important for you not to be scared of losses, and it is something that traders don't really want to address when they're starting to learn how to trade. But the reality is taking a loss is inevitable, and it's an inevitable part of trading these financial markets. So really it's something that can be embraced, but do focus on trying to mitigate those losses efficiently, and that is really a judgment call, and we'll discuss a few alternatives now very, very shortly. Okay, so that's just a brief introduction to trade management. So just before we delve into a little bit more about trade management and looking how to do it successfully or efficiently, there is a number of questions we need to sort of ask ourselves before entering a market. Now, the first question would be, do you have a methodology to assist with trade selection? So do you have a means by which you can narrow down? There's obviously a large volume of markets that can be traded, but do you have a way that you can narrow down exactly the markets that you should be focusing on, or that is more in line with your particular approach to trading these financial markets? And it's a very, very important part of trading, which is obviously selecting the higher probability trade setups, and that involves a bit of a process. So that's a very important question to ask. Next, you need to consider, do you have a directional bias? So do you, if you decide on perhaps 2 or 3 markets to focus on for your trading day or the trading session, do you know what direction you are looking to trade these markets? And I suppose this is where your trading strategy comes in. So, have a directional bias. So really you're looking for opportunities to buy a market, or you're looking for opportunities to sell a market, and perhaps not flip-flopping from one to the other just because the price is all of a sudden pushing higher. So you're looking to buy it and then you see it's pushing lower and you're looking to sell it. So again, that's a practice used by many new and inexperienced traders. So we would ask you to, make sure you have a directional bias when you approach these markets. Does your technical analysis support your trade idea? So you can use a whole variety of trading indicators and technical indicators. And there's other trading tools as well, support and resistance lines, and your understanding of Japanese candlesticks as well is all very technical. And really it's, do you have enough reasons to take a trade? Because this is what, this is how technical traders use technical analysis. They look for as many reasons as they can to execute a particular trade. Do the fundamentals and sentiment support your trade idea? This is an important consideration. Are you going against the sentiment? Are you going against the basic principles and the fundamentals? A good example recently is the move that we've experienced in the crude oil markets to the upside. It's been in an uptrend now for quite some time, and it's fundamentally backed by the OPEC and non-OPEC agreement to restrict the supply of oil. So that has a fundamental impact on pushing prices higher. And obviously there is this sentiment that can go with that move. And, so are you looking to sell the crude oil market? If so, you're going against the basic principles or the fundamentals behind the market. And you may be looking to capitalize on maybe short-term negative sentiment, which means a viable opportunity might exist to the downside. But the basic principle is, the more often you get in tune with the fundamentals and the sentiment behind the market, and if you do your technical analysis, it's all likely to support your trade, which is all important. So the next question to ask is, are you able to enter with a stop loss any particular market at a technically significant price? So that's really, do you know and can you identify and can you be accurate about your entry price and also your stop loss? Because if not, you might want to consider a technical approach to those levels. And the alternative to a technical approach would just be applying a 30 pip stop loss to a trade on an arbitrary basis. It's very subjective. You're determining the placement of that stop loss, when in actual fact we'd argue to work with perhaps structures or something of that nature, or technical levels that you can use either for stop loss and also for entry. So these are all very valid questions to ask yourself. Next one is the amount of risk you are taking on at an acceptable level. So the amount of capital you're exposing to the markets, is it something that you feel comfortable with? Is it something that you are dealing with a considerable amount of stress and anxiety in a particular trade? And often that is due to the size of that trade or the amount of capital you're risking. So if you are trading double-digit risk per trade, you're talking about 10+%, then the reality of that is you only need 10 back-to-back losing trades in order for you as a trader to experience a complete annihilation of your trading account. And you're only talking about 10 back-to-back losing trades, one after the other. So it's very rare, but it can absolutely happen. So really don't expose your risk, don't expose your capital in a reckless way. That's the point we're trying to make. A couple of last points. Do you know what outcome you're looking to achieve? So this is when you get into that trade, do you have a particular take profit in mind? Is there an area? It could be a technical area. It could be an area that is referenced from a fundamental perspective. Whatever the case may be, it's always good to have a particular target in mind. And finally, are you able to trade from a position of confidence? Because if you are, the more confident you are, and this is really putting everything together effectively, having the methodology to assist with trade selection, having a directional bias, doing your technical analysis in a competent manner, stacking up the reasons to take those trades, trying to get the fundamentals and sentiment in behind the trade idea. Can you enter technically at very accurate and very specific price points? Is the amount of risk you're taking acceptable? So are you comfortable with that level of risk? And do you have a particular take profit in mind as well? And all of these things will enable you to have a certain degree of confidence about that particular trade. Okay, so those are the questions to ask yourself prior to getting into that trade. And now, once you are in that trade, you then need to make a series of decisions that are likely to assist you in terms of managing that trade, so you can look to mitigate loss as quickly as you can, and also look to book in profit if the market moves in your favor. So let's go through this, and this is a dollar CAD daily time frame. So you can see the time frame along the x-axis, and the price, the change of price on the y-axis on the right-hand side. So what we'll do is we'll identify effectively what is happening around this level of support, and we're referring to it as a level of support because, and this is the area that we're really focusing on at this point, is that once price breaks above what was formerly a level of resistance, it becomes a level of support. So let's say we identify it's a long-term support level, and we get the break above that level, and you can see it's failed previously. So we get that explosive move to the upside, and we decide to get into this market. So this is move number one. The trader's quite happy. He's very likely to make a bit of profit over the next few days, and he gets that explosive move to the upside that he was anticipating. Now, when he gets into that market, he would do really, really well to use the level of what would be a level of support. Now we're breaking above it. He'd do very well, or she would, to use the support level to use as a technical stop loss, meaning, of course, the market could roll back beneath that level, but because it's a clearly defined level of support, it's less likely to. So what you're actually effectively doing is stacking the odds in your favor when you get into this trade. So let's say this trader decides to follow the price, and we get into trade number one, and as you can see, there's a bit of profit to be made there over the next few days, but as you can see, the price rolls back to the level of support. Now, that's not uncommon. That's a very common practice, and we get another opportunity to buy this market again just above the support level. You see a nice little doji candlestick in there, and we buy it again roughly at the same price, and we do it for a second time, place our stop loss roughly around the red line. Lo and behold, we get a third opportunity to buy just above that level of support. Again, the market pulls back. Hopefully you will have made, and I'm not really focusing on the actual outcome of that trade. Let's just say that the market moved higher for a number of days, and you were able to capitalize at least on a bit of a profit on that trade. Trade number three, market pulls back again, bounces off the level of support. You can identify and see that. You might want to take that trade for a third time. And lo and behold, we actually get a fourth attempt at being able to buy this level of support. So at this moment, and we can use our stop loss just below the support level. And if you can see, we do flush lower, but we don't actually enter the market until we break above that level, and that's just sort of a very basic approach to trading these markets. So you can actually effectively just amend that stop loss ever so slightly. And as you can see, hopefully, if you have, like we've said, if you have a particular take profit in mind and it's reasonable and it's perhaps a multiple of the difference between your entry or your stop loss, or it's a positive risk reward, then you have the chance to maybe capitalize on all 4 trades, or maybe 3 out of 4 of them. But let's look what happens. So this market threatens to pull back more, and eventually it makes a very, very marginal high, and we get this market pulling back to the downside. So what we've experienced so far is the Fantastic Four. So the traders feeling really, really pleased with themselves. They've had 3 or 4 winning trades out of those opportunities. So we've just experienced 4 winning trades, which is just basic principle, buying a level of support. So there's nothing overly sophisticated about that. Will we now get the 5th winning trade? So will this market now pull back to these levels, and will we get that 5th opportunity? But this is where I'd like you to draw your attention to exactly what happens within this circle, which is very, very different to what has happened previously. So I'd like to explain this in a little bit more detail, because what happens now as well to our level of support is that it actually now becomes a level of resistance. So we're getting that really confirmed break to the downside, and now it can provide us with resistance to the downside. So let's take that, and we'll dispense with the 4 winning trades, and we'll really focus on what's happening in those circles. Okay, so focusing on that same level, what we can clearly see at this point is we can clearly see a significant amount of momentum to the downside. So we can see the candlestick number 1, makes that concerted break, and we actually close beneath that level. And then what we see here is a significant amount of volatility driving prices to the downside. So what we're doing is we're looking at trade number 5. We're really seeing the difference that we've experienced from the last 4 trades, and now this is a different trade with a slightly different setup. So what do? We enter the market at point number 5, except this time we now have a bias to the downside, whereas previously we had biases to the upside. So we're now taking note of what's happening technically, and there's a different setup now applying to this market. So we look to enter this market at point number 5 with a view for this price to move to the downside. So when you enter the trade, look for opportunities to now mitigate risk or to look to book in profit. So let me talk you through the principle and the approach. So if we get in at this entry level, which is point number 5, just the green dotted line, and let's say for argument's sake we identify just above this high, and it's the other side of the level of resistance now, which is very likely to provide considerable resistance to prevent prices from breaking higher. So we place our stop loss at this level. And what we're looking to do is we're looking to benefit from a nice move to the downside from this level. And as you can see, that is what we get. Now, there's an option for this market to obviously pull back. It can do whatever it wants. What we do as traders is make sure we manage the trade. So at this point, if we don't book in profit around these lows, let's say we had to take profit around these kinds of levels. So we're looking to take profit in here somewhere. So that was our predetermined target. And as you can see, we didn't quite make it, but we got very close and we pulled back. So really, this is now creating what's called a structure. So once we see this and we see prices start to roll to the downside, mitigating risk as quickly as we possibly can is a really good approach to take. Because if we start moving lower and we get what's called a structural failure, then we're exposing this much capital unnecessarily. And it's really taking that very, very basic decision-making process and looking to take the risk off the table. So what we can do now is we can effectively break even at this point. So that is objective number 1 dealt with. We are now in a break even because we've created a structural high, and we're still aiming for the 2306 or the 2300 level, just down at these levels somewhere, to take profit. So that's what we're looking to do, and we get the structural failure that allows us to do it. So point number one is we can break even straight away. Then we can actually see that the market's taken made another structural high. So now what we can do is we can move the price from a position of break even down to a position of profit. So what you're saying is it doesn't matter what happens next, you are going to guarantee some profit in this trade, which is obviously a very, very good position to get in. But as you can see, this price starts to move down to your take profit level, and you're able to book in a really good trade in this example, and you're just capitalizing on what you've experienced around a break of a significant level of support and resistance. So that can be the process adopted by a trader to manage trade effectively. But as you can see, they're taking their time to mitigate risk. They're not necessarily doing it too quickly. Unless you decide to take profit at these lower levels, you'll have done well. And what you could effectively do is all of these markets often pull back to levels of support and resistance, and we can see that this market is pushing lower, and you might get an opportunity to get into this trade for a second time to the downside. But what you've done is you've broken even on your initial trade. You can bring down your profitable exit to a new structural high, and you can guarantee that additional amount of profit. And you can see that the take profit levels at these lows are very much achievable in this particular example. So that's really how a trader would go about capitalizing on the setup that we see before us, and would obviously be very happy with their ability to manage that trade effectively. So that is trade management in practice. Now, to give you kind of an alternative view, or basically a view which perhaps is trade management gone wrong, would be the same setup, identifying the support and resistance, looking at the entry levels, deciding to buy this market on multiple occasions to the upside, and they don't necessarily take note of what is currently happening around this area that we've just discussed. So we are seeing this price push lower. However, this particular trader is deciding, right, well, I've got incredible confidence that we're going to actually break back up to these highs. So I'm not going to trade with a stop loss. I'm not going to do anything sensible like that. So I'm going to get in above these levels of support, and the market pulls against me. And now they're thinking, right, well, if I buy at this lower level and I increase my risk, I'm very likely to get a little bit of a bounce to the upside, and I can actually be in profit once we break this initial entry. So that principle may stack up in their mind, and as you can see, the price continues to drop to the downside. So they start to double up again and look to buy at a slightly lower price, and said, look, surely, we've had this major drop. It's particularly extended, so surely we must get a turnaround around these levels. So we're looking to buy the lows, standing in front of a speeding train and saying, right, well, this market must turn now for me because I've done my analysis. This market has to move higher. So what I'm going to do now, I'm going to have complete confidence in my approach, and I'm going to actually buy at a lower level. But what I'm doing is I'm doubling down on my risk each time. So I'm incredibly expanding on the potential to start breaking or making money as this price pushes to the upside. So we get in at these lows, and all of a sudden we start getting into a good, things are starting to look up again. And because they've not really considered trade management, or that's not really a sincere focus of them, price starts to roll over to the downside. They ignore the signals and they ignore the structures that are created in this market, and they can experience potentially and realize a loss at these particular lows. And it's only an example of mismanagement. It's only an example of not identifying that things have fundamentally changed, and there's just this built-in belief that this market is going to start making new highs. So they double down. It's called the martingale principle. where it's the principle of looking to double down as the market moves against you in order to break even sooner rather than later. So it's the desire to generate profits. And if you suffer from this as a trader, it's a very difficult position. And what we've experienced in an example like this is not uncommon for traders, especially when they're starting out, is effectively a distinct lack of trade management. So there's no stop losses being used, and doubling down is often never a good idea at all. And the question we would ask is, how much of your capital has this approach cost you, and how do you feel at this point? Probably not great. It'd be like going into the casino and putting your hard-earned savings on black and ultimately losing. It's not a nice position to be in. So we're just firm advocates of being serious about trade management. Get into the markets for the right reasons. Do your analysis. Look at the questions that we've laid out at the beginning of this webinar, and just apply a very reasonable approach to risk management, and it can prevent things like this happening to traders. And we do appreciate as well that there's many educators out there that are kind of advocates of this kind of approach, which for us is a little bit on the irresponsible side, because it's not a great way to trade these markets. So just to conclude then, we've drawn a number of conclusions. Look to mitigate risk on a trade as soon as realistically possible, and that may take a little bit of time. Patience is obviously quite important as well when you're looking to manage trades. Look to do the same with profit. Avoid giving the markets and the benefit of the doubt. And the reason for this is markets can remain illogical far longer than you or I can effectively remain solvent. So that's a very, very important phrase to be aware of. It's that desire for the market to turn, which is only a desire that is created internally by the individual, and there's no need for the market to consider your thoughts and feelings. So it will continue to do what it does. The point is, don't put your capital behind the principle about you being right, or and don't certainly put your capital on the line, because these markets occasionally can remain illogical for prolonged periods of time. So you can get these major moves that don't make any sense, that don't necessarily add up, that it's not overly coherent. So that is something that should be taken into account. So the process of repeatedly buying as well a falling market, or repeatedly selling a rising market, because the same example can be explained to a falling market and also a rising market, can absolutely, in our opinion, be a recipe for disaster. So it's definitely worth considering. The moment you decide to take outrageous risk is often the moment you ultimately decide to give all your money to the markets, and that can happen sooner rather than later. So really control that particular risk. Finally, if you do not follow proper risk management practice, there will always be one trade around the corner that has the potential to get away from you. So please do avoid this from happening. So trade management, absolutely, this is the good news, improves with experience. So do bear that in mind. The longer you're in this environment, and the better you'll become at being able to manage those trades. So that just about concludes this particular webinar. So feel free to just review the webinar. We looked at some questions to ask before entering a market. We also looked at trade management in practice, and we looked at a situation in which a trader looks to double down on a losing trade. Never a good idea, and we just finished off with some conclusions. So that just about concludes this particular course. So all that's left for me to do now is to thank you very much for joining us. Do take care, and we look forward to seeing you soon. Bye for now.